The average new car payment in the United States is now $726 per month. This is not a statistic about transportation. It is a data point on the cost of signaling success. That payment is financed with over 68 months of your future labor. Labor you have not yet performed, for an asset that loses 20% of its value in the first year. This is the primary gear of a mechanism called the status debt engine. It is the system that converts rising income into escalating liabilities. It ensures that your net worth remains anchored to zero, no matter how high your paycheck goes. It is not a personal failure. It is a structural feature of consumer credit. This engine is highly efficient. A 2023 study found 61% of Americans live paycheck to paycheck. This includes 47% of those earning over $100,000 per year. High income does not correlate with wealth. It often correlates with higher quality debt. The system expanded rapidly after the 1950s. Credit cards and mass advertising were perfected. They created a theater of consumption. Your spending became a public performance. The first layer of the engine is simple. It is called the visibility mandate. A $10,000 raise is not abstract. It is a tangible pressure to upgrade your visible life. The car, the house, the vacation photos, your income increase feels unreal until it is displayed. A bank will gladly finance this display. Your $10,000 raise is about $580 per month after taxes. That new car payment is $726. You did not capture a surplus. You engineered a new deficit. The second layer is the reference point shift. As your income grows, your social circle changes. Your new peers have a different baseline for normal spending. This is documented as the Duesenberry effect. Your consumption patterns are dictated by your immediate comparison group. You are not keeping up with the Joneses. You are trapped in their balance sheet. This shift happens quietly. There is no meeting. There is only a slow, constant pressure to normalize to the new average. This engine compounds over time. That $726 monthly car payment does not just vanish. It represents a massive opportunity cost. Invested at an 8% average annual return, it becomes $133,000 in 10 years. Over 20 years, that number is $430,000. The car becomes scrap metal. The potential wealth becomes a memory of transportation. The status debt engine consumed $500,000 of your future. It exchanged it for an accessory. The core of the system is not actually about your spending. It is about collateral. Lenders do not primarily sell money. They rent it, secured by assets they can easily seize and liquidate. A car is excellent collateral. A house is even better. The engine is designed to incentivize the purchase of large, repossessable items. Your desire for status provides the lender with a low-risk, high-return revenue stream. Capital Dispatch reconstructed this analysis from public financial records, economic research, and documented market data. Escaping this engine requires a mechanical procedure. It is called the surplus capture protocol. It has 3 steps. Step 1 is the automation intercept. You must capture the surplus before your brain can spend it. Set up an automated transfer from your checking to your investment account. This transfer must happen the same day your paycheck is deposited. If you get a raise, 50% of that new money is automatically moved. You never see it. You cannot spend what you do not see. This breaks the behavioral loop. Step 2 is the skill stack. Do not use a surplus to buy a liability. Use it to buy an income-producing asset. The most accessible asset is a high-value skill. $5,000 spent on a data analytics certification has a higher return than a vacation. It creates a new income stream entirely. This is converting surplus cash into human capital. Leverage is not a mindset. It is building something that produces output without your direct presence. Step 3 is the asset bridge. Your captured surplus must be moved into a durable position. Every dollar in a savings account is losing purchasing power to inflation. The historical average is 3.8% per year. This means converting cash into income-producing assets. This can be dividend-paying stocks. It can be real estate. It can be a share in a private business. The goal is to move your name from a payroll to an asset title. The system does not care if you are wealthy or poor. It only cares that you are a reliable consumer of debt. Your status is the collateral. Your future is the interest. The trap was never about what you earn. It was always about what you keep. Capital Dispatch, now you know the math.